Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the Risk Spotlight Portal, the premier forward-looking service for operational risk content. Let's get started. The Financial Conduct Authority, or FCA, recently published results from a survey of non-financial misconduct across the UK wholesale sector. It's the first time the FCA has looked in depth at how firms are recording and managing incidents like bullying, harassment, and discrimination. Findings showed a notable rise in non-financial misconduct cases reported between 2021 and 2023, with a particular focus on bullying and discrimination. Interestingly, it was the larger firms, particularly wholesale banks, that reported the highest number of incidents. The FCA expects these firms to benchmark their approaches to managing such cases, driving improvement in culture across the sector. It's intriguing to see how varied the data is by firm type. For example, while wholesale banks saw proportionately fewer sexual harassment cases, they reported more cases of discrimination than brokers. And here's a compelling point. 41% of concerns were categorized as other, highlighting just how challenging it can be to label non-financial misconduct accurately. That could include anything from alcohol misuse to inappropriate language. The FCA is keen to stress that, although the numbers are rising, this may not necessarily reflect worsening cultures. In some cases, a rise could indicate a healthier culture where employees feel comfortable speaking up. There's a lot of nuance here, and the FCA cautions against drawing rigid conclusions. However, one thing is clear. Firms need to up their game when it comes to governance and oversight. It turns out many of the larger organizations surveyed didn't even have the basics in place, like a formal governance committee or up-to-date whistleblowing policies. These are critical for navigating the complexities of non-financial misconduct. Now, let's shift gears to the ever-evolving landscape of artificial intelligence in financial services. The Bank of England, at the recent Central Bank AI conference, emphasized its approach to managing the risks and opportunities presented by AI. In his address, Chief Data Officer James Benford talked about AI being a step change for the financial sector, and not just in power, but also in complexity and governance needs. He highlighted the launch of the new AI consortium, which aims to bring together experts from public and private sectors to better understand AI's impact on UK financial services. The BOE's initiative is about ensuring the ethical, safe, and innovative use of AI, something that should resonate with risk professionals across the industry. And with data at the heart of AI, Benford stressed the importance of strengthening data foundations, particularly unstructured data, to fully leverage these capabilities. The BOE's new Trusted Framework for AI Governance, which focuses on principles like transparency and fairness, provides a benchmark for other institutions. On that note, a recent AI benchmarking survey from ACA Group's ACA Aponics and the National Society of Compliance Professionals, NSCP, shed some light on just how far the industry still has to go in implementing solid AI governance. Of the firms surveyed, only a small portion, 32% to be exact, had a dedicated AI governance committee. This leaves a significant governance gap, with many firms exposing themselves to unnecessary compliance and security risks. The survey highlights just how quickly AI adoption is outpacing the safeguards meant to govern its use. For instance, only 12% of firms had a risk management framework for AI, and an even smaller proportion had formalized testing programs. This is a critical area where we need to see rapid improvement. Regulatory scrutiny isn't going away, and in fact, with 92% of firms having no policies governing third-party AI use, risks in cybersecurity, privacy, and operations are on the rise. Speaking of AI risks, the Cybersecurity Agency of Singapore, CSA, and the New York State Department of Financial Services, NYDFS, have both issued guidance documents addressing the cybersecurity challenges posed by artificial intelligence. The NYDFS has highlighted some of the advanced threats made possible by AI, like deepfake-enabled social engineering, which, in one case, resulted in over $25 million in fraudulent transfers. This is a stark reminder of the power AI has not only to innovate, but also to amplify threats. Interestingly, the CSA took a slightly different approach, outlining a comprehensive framework for managing AI risks through every stage of the AI lifecycle, from planning right through to end-of-life management. This lifecycle approach is crucial as it acknowledges that AI risks are constantly evolving, and proactive management is the only way to keep pace. Let's turn our attention now to the European Commission's recent adoption of regulations supplementing the Digital Operational Resilience Act, or DORA, which will soon come into force in the European Union. DORA is set to reshape how financial services entities manage technology risks, especially those posed by third-party providers. The regulations will require entities to develop robust policies for ICT risk management, from resilience testing to incident response processes. DORA aims to mitigate the risks that come from the financial sector's reliance on a limited number of critical third-party providers. With less than 3 months until its enforcement date, financial entities across the EU are preparing to meet these stringent requirements. And before we wrap up today, a quick insight into the cyber insurance landscape. Gallagher Re has released findings from its second cyber loss trend survey, and it's a mixed bag for insurers. Cyber insurance rates have declined over the past year, which, while positive for clients, poses significant challenges for insurers trying to maintain profitability amidst a growing risk landscape. Gallagher Re noted an increase in claims frequency and severity over the past year, which only adds to the complexity. The report also highlighted emerging trends in ransomware, including double extortion attacks, as well as the unique challenges faced by SMEs, which often lack the defenses to fend off sophisticated cyber attacks. It's clear that the threat environment is not slowing down, and insurers are under pressure to adapt policy wordings and adjust risk management strategies accordingly. Now let's turn to key operational risk loss events reported last week. The first update is about JP Chase taking legal action against customers who exploited a viral ATM glitch. The bank has filed multiple lawsuits against customers who allegedly took advantage of a technical glitch that allowed them to withdraw large sums of money from ATMs using fraudulent checks. The so-called infinite money glitch, which gained popularity on TikTok in August 2024, involved depositing counterfeit checks and withdrawing funds before the checks could bounce. The bank is seeking to recoup more than $661,000 in total from the defendants across 4 lawsuits it has currently filed. The next update is about a major banking outage at ING Australia that led to a scam warning. On Wednesday, ING customers faced a significant disruption when they couldn't access their banking services for nearly 11 hours, affecting over 2,300 users. In response, ING issued a crucial scam alert, warning that fraudsters were contacting customers and falsely claiming they could help restore account access. The next update is about a major data breach at Interbank, a leading Peruvian financial services provider. Interbank has confirmed a significant data breach after refusing to pay a ransom demand. A threat actor claims to have leaked 3.7 TB of company data, potentially affecting 3 million customers. The next update is about Bank of America's disclosure of a regulatory probe into Zelle transactions. It has revealed that it's under investigation by the Consumer Financial Protection Bureau, CFPB, regarding its handling of Zelle payments. This probe is part of a broader investigation by the CFPB into how major U.S. banks, including JP Chase and Wells Fargo, handle customer complaints and disputes related to Zelle transactions. That concludes this week's operational risk updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.